Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in Berlin, 3 days ahead of Germany's election. Mercedes releasing full-year numbers as we get a gauge on Germany's crucial auto industry. Oliver Crook standing by to unpack the results, as well as the latest on the election race. At 6:40 a.m. UK time, I'm going to be speaking with the GetYourGuide CEO on the German tech ecosystem. And at 8:30, we're going to check in on the energy space with Claudia Comfort, Chief Energy Analyst at DIW Research. But first, here are the stories that set your agenda. President Trump says a new trade deal with China is possible, touting his great relationship with Xi Jinping. Stocks in Asia drift lower. Donald Trump steps up his attacks on Ukraine's president, saying Volodymyr Zelenskiy is doing a, quote, terrible job, as the US pressures Kyiv to accept a deal to end the war. Plus, Europe's automakers report going to bring you earnings from Renault and Mercedes. The earnings dropping right now with a focus on Renault, seeing full-year operating margin coming in at 7.6%, slightly softer than the estimates of 7.74%. This is a stock that's performed well over the last 12 months, up a little over 40% as they navigate a challenging situation, of course, when it comes to global automakers. Some other lines crossing in terms of the dividend, full-year dividend per share coming in at €2.20. Below the estimates. Free cash flow, they're seeing for 2025 around €2 billion. And again, the operating margin a little softer. Full year revenue coming in at €56.2 billion. That was above the estimates of 53, just shy of 54 billion. Net income coming in softer for the full year. Net income of €752 million. The estimates had been for 1.72 billion. So a big miss in terms of full year net income, though revenues on the top line full year was stronger than the estimate. So a couple of key lines coming through from Renault. Let's switch focus to the German automaker within the luxury and high-end space. Mercedes, and the stock there has performed very differently, currently down over the last 12 months by about 3%. The redhead crossing the line right now, Mercedes sees 2025 cars adjusted ROS at 6% to 8%. The estimates had been for 7.91%. In terms of full year profit, coming in at €10.4 billion. The estimates had been for €9.87 billion. So full year profit coming in slightly higher than estimated. They expect to see buybacks of up to €5 billion up to 24 months. Let's bring in Oliver Crook right now, who's been breaking down the numbers for us, of course, constantly has the finger on the pulse of the German auto sector. Ollie, talk to us about what the numbers say to you from Mercedes, how challenged this automaker is, and the outlook going forward.
Yeah, so listen, the top lines here, as you were just outlining, there were a couple of beats in terms of what we were looking for in terms of profit, in terms of actually the margin. The margin did better than anticipated, came in at 8.1%. Estimate was for 7.4%. These are sort of beats, but we should put this in the broader picture. This is a company that has just reported numbers down in double digits percentage terms in almost every sort of sector. Revenue was down 5%, earnings, EBIT was down 30%, net profit down 30%, free cash flow down 20%, earnings per share down 25%. This is the picture for the auto industry looking right now. So those are the numbers there. What we're also getting from Mercedes, and this is significant here, is a cost-cutting plan, a performance-cutting plan. They want to cut costs 10% across the board by 2027. You can read that, potentially job cuts. This is going to add to the industrial difficulty story here in Germany. When we're looking in terms of the outlook for it, you mentioned the return on sales. What they're expecting is 6 to 8%. Again, this is a car maker that likes to get those numbers into the double-digit percentage returns when it comes to their actual sales. And their buyback policy, as you say, going to buy back about €8 billion worth into over the next 2 years. And again, we look at the outlook. We look once more for what is there any sort of sun on the horizon. It does not appear so. They're expecting EBIT to be significantly below last year's level again. So again, overall, a couple of beats within the numbers here, but a very sort of negative story. And it seems like the cost-cutting plan has now arrived at Mercedes-Benz.
Yeah, and the analyst note suggesting that is key, isn't it, going forward? The cost-cutting plan plus the guidance for 2025, 2026, though, as you say, potentially challenging to look through that, given the geopolitical and trade tensions that exist now between Europe and the US. Talking of which, that folds into, so of course, the debate here in Germany ahead of the election. Where do things stand 3 days out from that crucial vote?
Listen, I think the most remarkable part of this election is the fact that basically nothing anybody does seems to change the polls. And that's basically what we've seen for the last basically 3 months, where the CDU holding at about 30%, the AfD at about 20%. I mean, you get a couple of points up and down. You get SPD, coming up a little bit. But again, going into this election, I think that what we have seen is basically very solid numbers that have not really moved a whole lot. This is a point that was made in the debate last night, where basically Friedrich Merz considers himself already sort of the victor of this election. I would caution that a little bit, Tom, because everybody I talk to in Germany, a huge proportion of them say they don't really know who they're going to vote for in this election. And we see it in some of the polling that a large proportion of the German population has not yet decided. That does not necessarily mean that there will be a large upswell for the AfD, though this is a sort of new scenario where the AfD is doing so well. We don't know how forthcoming people are going to be about whether or not they're going to vote for the AfD, but it could mean a diminished number for the CDU. And if that falls significantly, those votes could be redistributed across the political spectrum. That causes once again a very difficult coalition discussion in Germany, which will take at least a month to form a government. I say at least. Everyone says a month is really fast.
Yeah, Morgan Stanley saying April at the earliest. And to your point, undecided voters, if you put the two statistics together in terms of those who have decided or undecided as to whether they'll vote at all, or those who are still not sure which party to vote for, is around 30%. Yeah. So it's a significant number, isn't it? Though turnout is typically pretty high in Germany, 76% last time round in 2021. Bloomberg's Oliver Crook, thank you very much indeed. Breaking down, of course, the auto numbers, the earnings coming through from Mercedes, that is so central to the question of the economy and the challenges here in Germany, how that ties into the politics, of course, as well. We're going to bring you all the news and analysis and market moves as we continue to build up to the German elections, including a special programme when polls close on February the 23rd, live from Berlin. Let's get to the markets now. You saw European markets dropping yesterday, 0.9%, having hit record highs the day before. Today, you're trading looking flat, essentially. European futures searching for direction. The increased geopolitical tension, of course, between the US and Ukraine is not helping sentiment. FTSE 100 futures pointing to modest gains of 0.1%. S&P futures having notched the S&P 500 a fresh record high yesterday with gains of 0.2%, currently looking lower by 0.3. So pointing off by about 19 points so far on S&P futures. Nasdaq 100 futures also pointing lower by 0.4%. Let's flip the board and have a look cross asset. We've been hearing from Fed speakers. We had the minutes, of course, and there seems to be a view that this is a Federal Reserve that is in no rush to move forward with additional cuts. Markets still pricing in between 1 to 2 additional cuts this year. 451 right now on the benchmark 10-year with yields down 2 basis points. Euro dollar at 104, a little stronger by 0.1%. Brent trading at $75 a barrel, down 0.2%. And Bitcoin in focus with additional Trump comments supportive of the crypto space. 96,800 currently up 0.5%. Let's cross over to Asia right now and check in with Avril Hong, who is in Singapore, for a guide on the Asian markets. Avril.
Yeah, Tom, we're seeing Asia stocks down again today. No thanks to those geopolitical tensions between the US-Ukraine tariff talk, even though Trump is saying it's possible a new trade deal with China. Then those Fed minutes also not helping. But today, the key test for Hong Kong markets going to be those Alibaba earnings. This is a stock that's run up 60% since the January lows. It's become big enough that its earnings event is to Hong Kong markets what Nvidia is to the US. Options traders expecting bigger than usual gyrations. If those earnings disappoint, that could really play out and hit the broader markets. Of course, today we've also been keeping our eye on dollar yen fast approaching the 150 level. Some of this has got to do with the other side of the trade, what we're seeing the greenback slumping, but also a regular meeting between the BOJ governor and the Prime Minister Ishiba, in which they apparently did not talk about rising yields. So sounds like a green light for further rate hikes. We're seeing higher yields, yen stronger, and this chart, courtesy of MLive's Mark Cranfield, shows you the flattening of the yield curve, and that also points to how dollar yen's path looks to be downward, lower. Tom.
Okay, Avril Hong in Singapore, thank you very much indeed. Fed minutes right now, showing officials expressing readiness to hold US rates steady until they see more progress on inflation. Federal Reserve Vice Chair Philip Jefferson says a strong economy allows policymakers to take their time.
A cumulative cut in the policy rate of 100 basis points last year has brought the stance of monetary policy closer to a neutral setting, monetary policy continues to be restrictive. I believe that with a strong economy and a solid labor market, we can take our time to assess the incoming data to make any further adjustments in our policy rate.
Bloomberg's Valerie Teitel joining me now for the analysis on these Fed minutes. Valerie, I don't know about you, but what stood out to me was less that this is a Federal Reserve that is comfortable being on hold for now, and more that they actually discussed whether or not to pause or sideline quantitative tightening. What stood out for you?
Yeah, that's right, Tom. The devil was really in the details. There wasn't a lot of new news on the rate outlook. Yes, the Fed is likely to be on an extended pause here until we see more progress on inflation. But the very interesting part came with their discussion of quantitative tightening. There was a discussion around the concerns about the debt ceiling slowdown, possibly meaning that they need to slow or perhaps pause quantitative tightening. Now, that could be the first hints that the Fed is maybe concerned about the low level of reserves in the financial system. So this one is one to watch. Treasuries rallied a bit on this as well. Equities also liked that hint about a pause to quantitative tightening. But conversely, Tom, I want to talk about how the European bond market closed, because in juxtaposition to how Treasuries traded strongly, we did see a fourth day of weakness in European government bonds, taking the German 10-year yield over the last four sessions higher by nearly 13 basis points. This is all around the story of further debt issuance to come in order to fund defense spending. It was also a very weak session for European equities. That rally that's really taken 2025 by storm, finally seeing some profit taking. The Eurostoxx 50 index had its worst day since December, down 1.3% in yesterday's trade.
OK, the impact on the bond markets in Europe and the profit taking across European equities. Bloomberg's Valerie Teitel breaking down the market moves with the overlay, of course, of those Fed minutes. Thank you. Here's what else we're thinking about for the day ahead then. 1:30 p.m. UK time, and this turns and ties into Fed considerations, of course. We get US initial jobless claims. Is the labour market still showing that resilience? There has been evidence of some cracks to this labour market in the US, so that data will be important. And then at 12:30, 2:30, 5 p.m. in fact, UK time. There you have the specificity on the time. 2:35 p.m. UK time. We're going to be hearing from the Fed's Goolsby as well. So another Fed speak, and we'll see if the consensus continues around the comfortable nature of this Federal Reserve staying on hold for now until they see more progress on inflation. And at 3 p.m. UK time, we're going to get Euro area consumer confidence. So a gauge on the health of the consumer in the Eurozone. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on the terminal. Coming up, President Trump denounces Ukraine's Volodymyr Zelenskiy as a dictator, saying unless a deal with Russia is reached, he won't have a country left. We're going to bring you the latest on the growing tensions between the US and Ukraine. That is next. This is Bloomberg. Welcome back. President Trump has stepped up his attacks on Ukraine's leader after earlier labelling Volodymyr Zelenskiy a dictator as he pressures Kyiv to accept a deal to end the war. Trump, speaking at a Saudi-run investment summit in Miami, took new aim at the Ukrainian president.
I love Ukraine, but Zelensky has done a terrible job. His country is shattered, and millions of people have unnecessarily died. And you can't bring a war to an end if you don't talk to both sides. You got to talk. They haven't been talking for 3 years. So we hope to see a ceasefire soon and to reestablish stability in Europe and the Middle East.
OK, let's bring in Bloomberg's Tony Halpin. Tony, this does not seem like it's going to end particularly well. The tension is clearly there between these two leaders now.
Yes, that's right, Tom. After this week's US-Russia talks in Saudi Arabia and the phone call between President Trump and Russia's President Putin, Ukrainian and European leaders were already pretty gloomy about the prospects for relations with the US in trying to reach a deal to end the war. And this comes close to something like a breach between the US and Ukraine now, which relies on the US as its biggest military and financial ally in resisting the Russian invasion. And it was really striking that President Trump outlined, as he put it, how Zelensky had done such a terrible job and that his country had been shattered and that so many people had died. But he didn't at all appear to draw the conclusion from that, which is to identify the person responsible for causing all this death and destruction, which was Russia's President Vladimir Putin, who started the war. And certainly in the Kremlin, they'll be delighted by this turn of events. Russian state television is already very pleased and clearly believes that the US under President Trump now is taking much more their perspective on this war and are quite hopeful that terms will be favourable to Russia when some kind of deal is proposed.
Yeah, and we've heard European leaders trying to push back on a Trump that, as you say, is now mirroring the talking points of the Kremlin on this conflict. How much support can Ukraine expect to get from Europe? Can they rely on European support?
Yes, European leaders have very much been put on the spot now because it's down to them whether Ukraine will get continued support if the US begins to pull away to try to pressure Zelensky into agreeing to a deal. The UK and France are putting together what's being called a reassurance force, which in itself doesn't sound very reassuring, but the idea seems to be that there'll be something like 30,000 European troops who would help to protect Ukrainian cities and critical infrastructure like ports. But crucially, they would not be deployed along the front line areas in eastern Ukraine. And that's 1,000 kilometers, something like a 600-mile front line. And under any peace agreement, somebody would have to police that. Estimates have put it at something like 100,000 troops that would be required to do that. But already many European countries are saying that they won't be ready to commit troops to the ground in Ukraine to help any such effort. So much of it's going to depend on US support. British Prime Minister Keir Starmer is going to Washington next week to try and sell this idea to President Trump. But Russia has said it's against European troops in Ukraine. And so on current form, you would imagine that Trump might be willing to listen to the Russian argument.
Which is a pretty terrifying thought for those sitting in Kyiv, no doubt. Bloomberg's Tony Halpin, thank you very much indeed with that important update. Now, US-Russia talks, and those talks, of course, continue to decide the future of Ukraine. South Africa is hosting the continent's first G20 Foreign Ministers Summit. However, Secretary of State Marco Rubio will not be in Johannesburg, citing an agenda that includes, as he puts it, climate change and DEI. For more, let's go to Johannesburg and Bloomberg's Jen Tabasaja. Jen, what can we expect then from the G20 agenda over the next couple of days, and how much of a blow is it that the US Secretary of State is not going to be there?
Yeah, Tom, good to be with you. It's quite a blow for South Africa, especially if you consider this is the first time we're seeing an African country hosting the G20 presidency, and the country is meant to pass off the presidency to the U.S. Next year. But still, we're hearing from South African officials still saying that they're expecting this to be a fruitful first meeting and focused on what the theme is this year, which is solidarity, equality, and sustainability. Now, the interesting point here is that we have seen a lot of the G20 cohesion between these members really eroding over the past few years when you look at a lot of the geopolitical disputes that we've seen globally. And so at least for President Ramaphosa, he's hoping to at least try to strengthen multilateralism and strengthen some of the partnerships, not just for South Africa, also for the African Union that is going to be a part of this, and the Global South, as he says it, and also try to focus in on their developmental agenda and focus then in on what this looks like going forward, especially if you consider some of the reversals that we've seen from the Trump administration. But not having Marco Rubio there in his new role as Secretary of State potentially sets up other countries then to step in and take a stronger approach and a stronger relationship with a lot of the countries that make up the G20 here. So we'll see where these conversations go and whether or not Trump and the rest of the U.S. delegates actually get on board with the G20 as the year progresses.
Yeah, because for Marco Rubio and the Trump administration, equality is now a dirty word. Bloomberg's chief Africa correspondent Jennifer Zabasaja on the ground for us in Johannesburg at the G20. Thank you for that update. And Africa's rocky relationship with the US under President Trump is the topic of the first episode of our new monthly show, Next Africa. You can catch that on Friday, February the 28th at 5:30 8:30 p.m. London time. Coming up, they don't make sense. Canada's international trade minister gives us a frank assessment of President Trump's proposed tariffs. We're going to bring you our conversation with Mary Ng. That is coming up next. This is Bloomberg.
It's possible. Well, we did a great trade deal with China. We did it great for the farmers, great for manufacturers. They had to buy $50 billion worth of our product, and we were making them buy it. The problem is that Biden didn't push them to adhere to it.
President Trump saying a new trade deal with China is possible. Meanwhile, Canada's trade minister says Donald Trump's tariffs only make goods more expensive for Americans. Speaking to Bloomberg, Mary Ng reiterated a vow to retaliate if the country's largest trading partner goes forward with import duties.
We've been very clear. Tariffs are expensive for America. They make no sense. When 70% of what I export into the United States takes, adds value to it, and then helps them be more competitive with their products. Adding a tariff just simply makes it more expensive for Americans. Adding tariffs to Canadian exports simply means that it's going to cost Americans more at the grocery store. It's going to cost Americans more at the pumps. So it makes no sense. We will continue to reiterate that message. We've been very clear. We will not. We don't want to be here. We don't want to initiate anything. But should there be punishing tariffs on Canadian and on Canada, we will respond accordingly. But in the meantime, we are having conversations with the Americans, as we do. When you have a trading partner like the one between Canada and the United States, where Canada is our largest trading partner, but we're pretty important to the Americans as well. When I count 36 American states as my top customers, I sell more to them, to those 36 states, than China, than Japan, than the United Kingdom and France combined. So we need to work on this together.
That 30-day pause, you're in talks right now. How confident are you that can be extended, that will be extended?
We are working very hard on that, myself, the Prime Minister, my cabinet colleagues. This is a really intentional effort to work with the administration. One of the things that the American administration, including the president, have raised concerns about is how we can collaborate and do more on border to make sure that at the border we are indeed working more together. Despite Canada only having less than 1% of fentanyl going into America, it too is just as a concern for Canadians. So collaborating together to make sure that we are doing more on our border is what we are doing. And we're confident that that work is not only making progress, but that we're doing that with the Americans. And this is the testament of the Canadian-American relationship as well. The ability to talk through and work through what are sometimes really tough issues. So we're committed to doing that on our end.
Canadian Minister of Export Promotion, International Trade and Economic Development, Mary Ng, speaking to Bloomberg's Haslinda Armin. There is plenty more coming up. We're going to do more analysis, of course, on the German elections. We're going to speak to a CEO of one of Germany's most well-funded startups to talk about what the tech scene here in Germany needs from the next government. Stay with us. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in Berlin. These are the stories that set your agenda. Happy Thursday, everyone. President Trump says a new trade deal with China is, quote, possible, touting his great relationship with Xi Jinping. Stocks in Asia drift lower after the latest Fed minutes show fresh caution on rate cuts, weighing on risk sentiment. Donald Trump steps up his attacks on Ukraine's president, saying Volodymyr Zelenskiy is doing a, quote, terrible job as the US pressures Kyiv to accept a deal to end the war. And cost cuts for Mercedes. The German car maker looks to boost profitability after warning earnings will be significantly lower this year. European stocks fell 0.9% yesterday. Currently, futures looking for direction, turning slightly higher, in fact, as we lead up to the open. 8 a.m. UK time, 9 a.m. here in Germany. European futures currently pointing to gains of 0.3%. FTSE 100 futures looking to add 14 points. S&P futures currently pointing lower by 0.3% after hitting fresh records yesterday. Nasdaq 100 futures pointing lower by 0.4. Let's flip the board and have a look cross-asset then. Currently the US 10-year, you're seeing yields a little lower. Fed minutes suggesting again that there is caution amongst this Federal Reserve, also discussing the possibility of ending or at least postponing quantitative tightening. So the 2-year yield is down 2 basis points, 4.50 right now on your US benchmark 10-year. Euro getting a bit of a lift. The dollar is softer today. Euro up 0.1% versus the greenback. Brent trading at $76 a barrel and Bitcoin at 96,000, close to 97,000, up 0.7%. Worth noting that gold continues to push through fresh record highs as well. Let's get the latest on the earnings story from Schneider Electric now. And this time, in terms of the full year adjusted EPS for Schneider Electric, the French firm, of course, in the industrial and electrics space, coming in with full year adjusted EPS above the estimates, €8.32 above the estimates. In terms of fourth quarter organic revenue, that was also a beat, increasing 12.5%. The estimates had been for 8%. And they're looking at a full year dividend per share of €3.90, also above the estimates. Very pleased to say I'm joined now by the CEO of Schneider Electric, Olivier Blum. Olivier, let's start with your reaction to these results, what it tells us about how well positioned this business is going forward in an environment, of course, of increased geopolitical tension.
Good morning. Thanks for having me. Indeed, you see that our results have been pretty good for 2024. It's a record year for us in terms of sales at 38 billion. So as you rightly say, it demonstrates the right positioning of Schneider Electric today in a world where electrification and digitalization is super important in all segments. So definitely it demonstrates the strong execution of our strategy and very encouraging for the future as well.
Olivier, you've been in the job, CEO, for less than 6 months. What are your key priorities as CEO over this year?
You know, I've been in the job for 6 months and 32 years in the company. So it's great to be in this position today. Well, look, as I said, you know, the position of the company is fairly simple. We develop all the technology that helps to converge electrification and digitalization to help you to manage energy, to make energy efficient. What are the priority of Schneider Electric is to accelerate. We are in a favorable growth cycle. We said a year ago that we project 7-10 to 10% across the cycle by 27. I continue to believe with the team that this opportunity is in front of us. So our job is really to execute, to accelerate the transformation, and to continue to increase the part of our portfolio which comes from our digital business.
On a regional basis, North America is a standout for you. Organic growth of 22%, well above what we're seeing in Europe and the APAC region. Does that outperformance for North America continue?
Yes, absolutely. We have seen that, and it's not the first year, and I'm sure you follow Schneider and you know that. But we have, of course, favorable market in North America since a couple of months, and it was the same the year before. We've seen an acceleration in 2024, which is also partially due, but not only with all the positioning we have in data center, which was very favorable again in 2024. And we are very excited because it will continue definitely in 25 and beyond.
That continues, because another key question, of course, you've seen that double-digit growth in the data center business. DeepSeek coming through with those efficiencies. Have you had any clients, any customers say, do you know what, we need to spend less on data centers? Are you seeing any chill wins on that build-out of data centers going forward?
You know, for us, the best way to answer your question is to look at what we have in our backlog, but more what we have in our pipeline. And usually our pipeline gives us an indication at least of the next 2 years. So to answer your question straight, no, there is no reduction, there is no slowdown. Now, when we step back and when we look at DeepSeek, I think it's just a signal that AI is a reality, that also the consumption of AI will keep on increasing. I think it will make it available and accessible to a larger audience. So for us, it's rather a good news. It's a confirmation that what we saw last year and this huge increase of AI and therefore data center infrastructure is really a confirmation, a serious trend for the next 2 to 3 years at least. Beyond that, it's difficult to say.
Are you factoring tariff risks into your outlook, Olivier?
Well, look, we are getting ready. We follow the news every day. What is very, very important, what I can confirm, and you have seen our guidance, in any situation, we are ready to activate and to protect our profitability to make sure that we'll deliver a profitability within our guidance. You have to know that, for instance, in North America, we produce 83% of what we sell in North America. We are fairly balanced and ready to activate any kind of plan to protect our profitability in 25.
We had some auto earnings today, and it's a reminder that there is this slowdown in growth and in demand for electric vehicles. Is that having a slowdown in demand for electrification?
Not really for us, because you know this demand in electrical vehicle and therefore in EV charges came on top of everything else that we were doing. On top of that, Schneider Electric, I remind you, has a huge exposure to data center, buildings, industry, and the EV charging is just a fraction which is impacting on our overall growth. So what we've seen probably 2 or 3 years ago was definitely very high increase. It's coming back to something which is a little bit more normal and which was what we were anticipating. So no real impact for Schneider Electric.
I just want to get one question on taxes, Olivier, because LVMH, a very different space, of course, but another French conglomerate and giant, has suggested they're facing potentially a 700 million euro hit as a result of higher taxes, as a result of this new French budget. What is the hit likely to be for Schneider Electric as a result of higher taxes in France?
No, we are not impacted by this kind of measure, so you cannot expect any major impact, any change for Schneider in 25 on this topic.
There's no tax impact?
There will be no significant change compared to what we have today already.
Okay. Schneider Electric CEO Olivier Blum, thank you. We appreciate your time on the back of these earnings coming through from the industrial giant over in France, of course, with that tilt towards data centers and very strong growth once again in North America. To the tech space, with a focus, of course, on the Chinese e-commerce giant Alibaba, also tied, of course, to AI. Due to report earnings later today, after that AI-fueled rally added more than $110 billion to the Chinese tech giant's market value. Let's go to Bloomberg Asia tech reporter Annabelle Drulers for a preview. Annabelle, what are you going to be looking for?
I think there's going to be a lot of things we're going to be looking for in these numbers, Tom, but I think chief among them is going to be how exactly is Alibaba capitalizing on not just DeepSeek, but also just this general optimism that we're seeing coming back into China AI-linked names. Because you think about, you mentioned that huge rally that we've had. This is actually interesting as well to note, because that's the sales of Alibaba, and you can see actually they've been in pretty much single-digit territory for quite a while now. So on the one hand, you've had this big rally in Alibaba. On the other hand, you've still got these domestic concerns around China's economy. This is a company that makes 90% of its revenue from mainland China. You've got ongoing weakness in consumers, for instance. How are they going to be grappling with that, and how are they also managing to get ROI here? So there's going to be particular focus on the cloud business. Actually, we're expecting that revenue or that division to have increased its revenue to around 9% on the quarter. That would be up from the previous quarter of 7% growth. And certainly going to be watching for any signs as well in the earnings call. How can Alibaba fend off the competition? Because when you've had the likes of Baidu, Tencent, just in the last couple of days, also integrating DeepSeek, Alibaba's already done that into its product offering. This is a technology that's even more becoming commoditized now, standardized. How can you stand out from the pack?
Yeah, I mean, as you say, it's one thing to build that AI model, the foundation model QN 2.5, which performs, as you say, very well, but it's another to get that return on investment. Maybe that's a factor. Maybe that's what's been considered by some of the analysts getting a little cold feet now, given the run-up we've seen in Alibaba's stock, and saying maybe take some profit at this point.
Yeah, and to your point, I mean, you mentioned some of those figures. You're looking at a stock that's risen 60% just this year alone, and we're only in February. So it's been a very short and sharp rally for this name. Huge amount of market value that's been added as well to the stock or market cap. you're trading above the analyst 12-month price target. That's been very unusual for Alibaba over the past few years, really. So yes, some are saying this is an opportunity to take profit. JP Morgan, for instance, is saying you could trim or think about trimming your exposure to extremely overbought China AI proxies. So they're looking at Alibaba, Alibaba Health, Kuaishou, Tencent. They're actually looking at other shorter-term tactical plays, so China property, for instance. But longer term, they still are optimistic on the AI story. It just sort of points to what is really going to be a big test for a lot of China tech names. Can they stand up to the expectations? So we talk a lot about those high bars that big tech has to clear in the US. Maybe it's looking similar. And actually, our colleague Mark Cranfield from the Bloomberg MLive team had a really great way of looking at it before. And he was saying Alibaba is like NVIDIA. It's Asia's NVIDIA story for the Hang Seng. And that's how important and prominent this name is going to be for the broader market outlook for this region.
Yeah, that's quite the comparison, isn't it? Bloomberg's Annabelle Drulas, thank you very much indeed. Excellent preview of what we should be looking for from those Alibaba earnings dropping in the next few hours. Now, some other stories making the news this Thursday. To the mining space, where Rio Tinto shares closed lower in Australia after the world's biggest iron ore miner's annual profit missed estimates. Underlying profit was 7.6% lower than last year, but strong growth in the copper business helped to offset soft iron ore prices. Rio's rivals, BHP and Glencore, also reported weaker earnings earlier this week due to slumping demand out of China. Coming up, German tech leaders call for bold reforms from whoever wins Sunday's election here in Germany. Our exclusive interview with the CEO of Berlin-based global travel platform and one of the best funded tech companies in Germany, GetYourGuide. That is next. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Thursday. It is 7:45 here in Germany, 6:45 of course in the UK. Germany's tech companies and startups are calling on whoever wins Sunday's elections, and significant they will be, to make bold reforms, warning that the country has fallen from a leader to a laggard. On the wish list are investing in digital infrastructure, increasing AI adoption, and incentivizing more high-skilled workers to move to Germany. Joining me now for an exclusive interview is Johannes Reck, the CEO of Berlin-based global travel platform GetYourGuide, currently valued at about $2 billion US, backed by the likes of SoftBank, KKR and Temasek. So some really significant names behind this business with about 800 employees. Johannes, you're very well placed to talk about what Germany needs, what the next government needs to do to prioritize building out the tech sector in Germany. What for you should be the key priorities of the next government?
First of all, Tom, thank you so much for having me on the show on such a beautiful day in Berlin. Germany is really at a pivotal moment at this time. We have lacked competitiveness over the last 10 years, and now it's really time to change that. So the economy and business, innovation and growth need to be on the very top of the agenda for the next German government. Specifically what we need, we have a huge funding gap in Europe. You might know that our pension system, unlike Canada, Sweden, or other more advanced countries in that respect, is a pay-in, pay-out system. And the government actually has to subsidize that system now with 100 billion a year. We need to move very quickly to a share-based or capital-based system where the retirement accounts are actually investing into our future, investing in the tech companies, investing into stock-listed companies here in Germany. So I would say
is this about getting long-term growth capital?
Long-term growth capital. If you even look at the IPOs here in Germany or in Europe, they're all backed by American funds. They're not backed by German funds. So that's terrible, right? So that is causing a gap of roughly 20x in terms of invested venture capital in the growth stage, and an even bigger gap in the growth equity for public companies here in Germany. And that's really something that we need to radically change right away. We need to change the incentive systems of how our pension system works, and also how they invest here in Europe.
Do you get a sense, whether it's from the CDU or the SPD, that they are actually listening to these concerns, that they're ready to act?
They are listening, but the big issue for them is that they partially need to go against their own constituents because at least something needs to give, right? You can't have that defunct current system and migrate to a new system without anyone, taking a cut, right? So I think that's the core issue there. Why for politicians it's been incredibly unfavorable to do it.
What is the scale of that innovation gap? Right now?
If you just look at let's take the innovation capital, the venture capital. That capital has a 20x gap between the U.S., so roughly 150 to 170 billion US dollars invested in venture capital in the U.S. in the last 12 months versus 7 billion in Germany and 50 billion across the entire European Union. So 500 million people in Europe had 1/3 of the venture capital of 300 million people in the U.S.
I've heard some notable US CEOs and venture capitalists saying, look, you can write Europe off when it comes to AI. But we see that there are AI companies being built out in Europe. Are we missing something here? Is the EU AI Act, is it a hindrance or is it a support?
So I think, contrary to at least American opinion makers right now, the EU is a very good thing for Europe. We need the single market. I'm a huge fan of the single market. It's great for European companies. Also, the current policy proposals of the 28th regime, so making it easier for European companies to scale, is great. And last but not least, the Digital Markets Act and the Digital Services Act are two really great pieces of legislation that should be put into action. We need a level playing field against American big tech in Europe. If we don't get that, we will not have growth of our sector.
JD Vance, the Vice President, says if Europe goes after big tech, then there will be reciprocal. There will be measures. There will be countermeasures. They will hit back.
That's absolutely in the American interest, and we have a European interest to defend too. So if you want to look out after European tech companies, if you want to have innovation and growth, you need to have a fair level playing field. And I think JD Vance actually has a bit more of a nuanced opinion as it comes to big tech as well. If you look at what he's said historically, but I understand where he's coming from. I think we in Europe now have to have backbone and need to defend our own digital companies.
When it comes to talent, there's a question about whether or not the rise in popularity of the far-right AfD has damaged Germany's brand and made this country less attractive if you are a foreigner looking to relocate here. Is that a concern?
I think next to the capital gap, attracting foreign talent is the number one blocker to growth and innovation in Europe. So we need to have more highly skilled migrants who come here to Germany and input into our economy. So this is in our common interest. So if we look at the past couple of years, we have not had enough of them. So my company, GetYourGuide, we employ 700 people here in Berlin. 85% of them are actually foreigners. We just hired a CTO from Netflix earlier last year, and it took him 6 months just to get a consulate appointment in San Francisco so he could fill out his paperwork. So that's how hard we make it for people to come over to Europe. So we need to digitize these things. We need to make it a lot more attractive. We need to lower taxes. We need to have more interesting stock option programs so that there's really a strong pull for people to come in here. None of that is policy of the AfD. We can't go back to the 90s. That's not the solution. We need to move forward, and we need to move forward by attracting global talent.
There's an argument from General Catalyst and others that you can take the Mittelstand in Germany, the strength of that industrial base, mid-sized companies, and layer on digital products, create efficiencies, and revitalize the industrial base of Germany. Is that realistic?
Absolutely. I think we sit on a treasure trove of data here, particularly when it comes to industrial manufacturing, when it comes to B2B services, and we need to leverage that. But it comes back to the level playing field. If we don't do that on our own cloud services, if we don't do that with proprietary technology, ultimately we'll sell out the Mittelstand. So we ought not to do that.
You've touched on the capital markets.
Yeah.
Does GetYourGuide list in Europe? What are you thinking about in terms of IPO timeframe and location?
So we're currently heads down executing the business, doing incredibly well. Global tourism, as you know, is booming and has been booming since the pandemic. We're now roughly 5-6 times the size. Pre-pandemic, we're profitable. So we have no rush, and we're currently really focused on the business, and then let's see what's coming.
Okay, Johannes, thank you very much for taking the time, for giving some insights into what Germany needs to do, what the next government needs to do to rebuild and close that innovation gap. Johannes Reck, the CEO of Get Your Guide. We're going to bring you all the news and analysis and market moves as we continue to build up to the German elections, including a special program when polls close. That's on February the 23rd, live from the German capital here in Berlin. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. So yes, we know the Fed is cautious. We know the Fed is on hold until it gets more details and data on the inflation story, particularly given the strength of the economy and the still relative tightness of the labour market. We'll get more labour data out of the US later today. But from the minutes that came out, the real key interest, I think, was around the discussion on quantitative tightening, whether to pause or suspend QT as they look ahead to the debt ceiling debate and concerns about liquidity functions within the markets. And so that was what stood out to me, at least from these Fed minutes. In terms of whether or not tariffs could be inflationary, that was also discussed. Potential impact on higher prices. Let's flip the board and have a look at how FOMC members are now starting to think about hotter inflation and the risks versus what's happening in the labour market. We have this chart that illustrates that. The yellow line is pointing to the expectations around the unemployment story. The level of concern about stronger labour market, that has dipped. Here's where the focus is on then. 15 members of the FOMC seeing the risk of hotter inflation. And that's where they need to see work being done before they have the confidence to cut again. Again, markets expecting just one, possibly two additional cuts this year. We'll flip the board and quickly look at the Japanese yen, advancing past 150 versus the dollar for the first time since December the 9th. We've heard some commentary from one BOJ member suggesting that additional rate hikes are possible, currently at 150 on the Japanese yen. The opening trade is up next. This is Bloomberg.